With us we have myself, David Jollie, so I'm Head of Sales and Market Intelligence at Anglo American, and two people who know much more than me. So Joni Teves, Precious Metal Strategist from UBS, and Bernard Dahdah, Senior Commodities Analyst from Teves, both of whom started contributing to the survey in 2015, so 5 years after me, and both of whom have won more first prizes than me in the time since. So clearly they do know vastly more. Joni's had a couple of first places in 2016, and Bernard's had the most sort of unlucky performance for a while recently, coming, I think, second, third, and third out of 4 metals last year, and therefore going home with a booby prize of nothing. So but he survived and he's smiling, so we're okay. So we're going to talk about the 4 main precious metals: gold, silver, platinum, palladium. We're not going to do it in a sort of Brexit-style debate and trying to tear each other to shreds, but if that happens, it happens. So really, I just thought maybe just give us a sentence each or a couple of sentences on how you see the complex ahead in 2019. I don't know if you want to start, Bernard.
Thank you. Just in general, in terms of precious metals, it's going to be the same story, at least for platinum, gold, and silver. It's going to be the question of the strength or the weakness of the dollar. I think palladium story is very different. It's much more of an industrial metal in my view, given that 80% of demand goes for cars. But back to the first 3 ones, our take on the dollar is that basically we think we're going to have a weaker dollar this year. The Fed is being more dovish. We don't expect any hikes this year. The market is starting kind of talking about rate cuts actually the year after. So you put that, you take into consideration the ECB, talk about ECB rate hikes early next year. So the market probably trying to factor in this information at the end of this year. So that's going to put more pressure on the dollar. The widening budget deficit in the US on the back of the Trump tax cuts, that's going to be another issue. I think that's going to be putting pressure on the dollar. And finally, also, I guess, we're reaching a situation in the US where we've got full employment, productivity is quite high. So basically, in terms of growth, a slowdown in growth. So all these factors combined together, I think, should lead us to see a dollar against the euro at 1.20, which should be like kind of supportive for gold and silver. Platinum, I think, is following pretty much what gold is doing, much more over the past few years since the diesel crisis, scandal. So basically, I suspect also it will follow into the movements of gold.
Okay, Joni?
Sure. So from my perspective, when I look at precious metals, I usually start with my gold view, and I think that sets the tone for the rest of the precious metals, given the correlations there. I expect a broadly range-bound gold market, similar range to what we've seen in the last few years, but perhaps trading at a slightly higher levels and better supported levels than we've seen last year, so an average of 1,300. But then after that, I look at there are some idiosyncratic fundamental factors within each market, perhaps more for platinum and palladium, not so much for silver at this point, I think. So the way I really look at silver is versus its relative performance to gold. And while gold can drag silver higher, I think that unless gold is in a very strong bull run, it doesn't really attract as much investor interest, and which is, I think, has been the weakest part of the silver market. Platinum, again, I think gets dragged higher by gold, but fundamentals are so weak that that journey higher for platinum is going to be very reluctant. And then finally, palladium, that's probably the precious metal within the complex that has very strong story of its own, and I think that is going to be supply and demand fundamentals for palladium are going to be the key drivers rather than its correlation with gold.
Okay, so if we head back just to the sort of economic picture, I get the impression from reading most of the analyst comments in the survey itself that generally I think there's a more bearish view about the dollar. Is that something you both hold on to? And do we see any potential upside for the dollar? Is the risk it's actually going to firm?
From my perspective, yes, we are calling for a lower dollar, but I think what has been a challenge for that view is that in order for a sustainable and sort of marked decline in the dollar, you also need growth outside the U.S. to pick up, particularly in Europe, and that has been disappointing. So while we do see, say, euro-dollar strengthening this year, that's probably going to take more time to happen. We are forecasting 120 for the euro-dollar by year-end, and I think that should be sufficient to provide support for for the gold market in that sense.
Yeah, interesting that you're forecasting exact same US dollar euro, but yeah, I would say I was giving like my view on why the dollar would be under pressure. Like if I were to think of reasons why that would contradict this, I think basically if you get a little bit more inflation in the US, then probably the Fed would be more willing, more willing to start raising rates again. I think the classic story of you raise rates, or the expectation of a rate hike, you get a stronger dollar. It's the opportunity cost of holding gold also increases, and then the price of gold drops. So that would be maybe the other flip side. I would say the risk is probably the inflation side of things.
And then are we in then an environment, a sort of Goldilocks environment, where we see a little bit of dollar weakness? We don't see that, we haven't got anything too exciting on the other side, and we're not seeing those kind of safety flows seeking gold as a safe haven. Is that a fair interpretation?
I mean, that could actually be an upside kind of scenario for gold, because if the investors start to move into that position where they look at their options of where they can put their money, and not necessarily the dollar, not necessarily Europe, because growth is not picking up there, and they're left with very little options, then that could actually be a case where gold could come out as the best alternative. And you probably already started seeing a little bit of that, and that's why we've seen gold perform quite well in the fourth quarter of last year and continues to hold really well so far this year. And adding to that upside risk is the fact that I think broadly speaking, allocations to gold have been cut back significantly, since the collapse in 2013. So there is certainly room for those allocations to grow again.
Yeah, if you just looked like at investor demand from physically backed ETFs from the start of this year, there's been a good performance. I think they rose by like 70 tons to roughly 2,300 tons, roughly there. So there is some appetite. I'd say that what's important also is to look at the U.S.-China trade, the negotiations that are currently taking place, because I think the tendency from what it seems for now is that we're going to get a somewhat understanding, something relatively positive, not a complete conclusion. And I think that would be positive for the market, it'd be positive for the stock market. And then you could see maybe price of gold suffering there as stock markets become slightly more attractive, because holding these physically backed ETFs are relatively expensive compared to some other assets. So yeah.
And then if we look at the physical side of the market for gold, we should never kind of forget it is a commodity after all. Do you see central bank flows as interesting, as relevant? I mean, they're data, so we discussed data, but are they useful data?
From my perspective, I think it is important. It's usually ignored because it's more in the background. You don't really know about it until a couple of months when you see it in the IMF statistics. But I think it does provide the market with underlying fundamental support. Some people say, well, the buying last year was very, very strong from the official sector, but how come gold prices are pretty much still range bound? Well, I guess the way I would think about it is, where do you think gold prices would have been if they weren't buying? At the end of the day, the way I look at it is that it is very long-term investment. So this is metal that is being taken out of the market for a very long term. You got something that you don't expect that will come back the next month when the data starts to kind of turn against gold's favor?
Yeah, I mean, it's a completely different story from the physically backed ETF side, whereby as quickly as they're a source of demand, investors, they turn into a source of supply. We saw that in 2013. I think since the financial crisis, central banks have shifted their strategy. It's clear those who were selling have stopped selling, and we've seen central banks from emerging countries diversifying away from the dollar into gold. That was at the beginning of the financial crisis, I guess, for the first 2-3 years. But then there was a change. Additions are still rising rapidly, but we have to look at who is adding. And those who are adding tend to be central banks from emerging countries who are actually mining gold. So be it Russia, be it China, be it Kazakhstan, especially Russia, is the overwhelming part of the additions have come from there. Whereas the beginning of the financial crisis, I'd say it was a pretty much Asian story with various Asian central banks that were diversifying away from the dollar because they had held so much since the Asian currency crisis back in the 90s. So basically we've shifted, I think, the additions now that are taking place is from central banks who are producing gold, from countries who produce gold. I think a lot of central banks now, some of them have reached the targets of the amount of gold they wanted to reach in their FX reserves. Again, these central banks from these emerging markets that I was mentioning. And we're seeing a bit more like dynamic hedging. So if the price of gold increases, there's some selling of gold to keep, your books in place. I think also in terms of central banks, I'd say leasing over the past few years has come back into more de rigueur, more in fashion than it previously was.
I disagree, or I don't disagree, but I look at
You're allowed to disagree.
I look at it slightly differently, I guess, because in the previous wave of central bank buying, to me, looked like it was a function of these emerging market central banks having their or seeing their total reserves grow. So basically, that kind of increases the need to diversify these reserves. Whereas this time around, you're not really seeing that sort of trigger. And I think, or it feels a lot more like a need or a desire to diversify away from U.S. dollar holdings.
Rather than just a broader, I have more money, I'm going to spend it somewhere on something different.
Exactly, because you're not, the likes of China, for instance, and they came in right at the very end of the year at adding 10 tons in December. It's not a big amount, but, just the direction, the fact that they became active again is quite an interesting thing.
So you would see the weaponization of the dollar potentially as something that drives gold if you look further forward?
Not necessarily. I think it's more like if, in a similar way that investors would think about it, if they're starting to look at a bearish dollar consensus and they're holding dollars, then you would start to think, okay, how do I protect these holdings? So gold is one way to do that, and I think that's been an underlying theme among these inflows that we've seen.
Okay. And then how much do either of you actually look at, say, India and China and their buying as an impact on the market? Or is that something that just happens in the background and, we expect it to be big and it will be big? And
yeah, I guess the two slightly different styles of purchasing between India and China. I guess India is more susceptible. It's more related to their GDP growth. It's more, you also talk about like the monsoon, if it's a good one or a bad one, because there's such large amount from the rural areas. I think China is interesting that they tend to be, slightly more speculative when it comes to gold. I guess there's up to some extent some people will be more willing to sell gold than an Indian person would be, than an Indian buyer would be. So I think China's emerged as kind of the market of last resort. Before 2009, Chinese additions, retail additions were almost inexistent. It wasn't, the government didn't encourage you. You didn't have the means to do it. And then all of a sudden, bang, 2009 came in. The Chinese government started to do this push to encourage their citizens to buy gold. And I think the best example to give is 2013, when we saw these massive outflows from physically backed ETFs, something like 800 tons. And probably the reason why gold doesn't drop underneath $1,000 an ounce is because there was this massive Chinese consumption demand. And I think there's the world pre-2009 and post-2009 in gold. And it relates to China because it wasn't a China buying that much amount of gold before 2009. So I think China is there to, in a way, makes me believe that basically we're not going to see again the price of gold below $1,000 an ounce, because it's a whole new massive market that's out there. Also, when it comes to China, I think the Chinese government is trying to push for China to become the global hub for gold, slightly taken away from New York and from London. So be it the fix that they set up, and be it the amount of storage, of vaults they set up. They're the biggest producer. They're not the biggest consumer. So it all falls into China is probably one of the most important hubs right now, and they've made it in no time.
I look at it quite closely because I think it is important in that sense that it does provide that support in the market when the market needs it. And although it doesn't drive price action in the short term, or maybe not even in the medium term, I think in the long term it still, it manages to underpin the trends and keep the market healthy. And I think seasonality of the buying in key physical markets like India and China is important to have in mind as well, because depending on when macro factors occur, macro catalysts occur, the seasonality could make a difference. So for instance, if macro factors occur during a period when physical demand is typically strong, then it means that you have probably a floor for the gold price nearer than when you would have it occur during a seasonally weaker period.
Yeah, we certainly, I think the talk around our office is certainly Chinese New Year coming up. Let's wait and see what happens. So it's our kind of unofficial holiday. We'll be in the office, but nothing will be happening. So it'll be a different thing. Yeah, well, in a way, snowed in, of course. So if we move on from gold to silver, we were talking before we started about the analyst's go-to phrase that silver is half an industrial metal and half a precious metal. I don't see from your comments in the survey strong views on silver. Is that a fair point?
That's totally fair in my case.
I think the interesting part for silver, just to throw it out, it'd be if you look at the beta, so taking the standard deviation here, basically it's currently at 1.4, so over the past year, which is up from 1.27, and what that's saying is that for a 1% move in gold, you should get a 1.4% move in silver. But in either direction, so if gold is dropping by 1%, then you'll see silver dropping more rapidly. And that's not, a massive discovery, given that we know that silver is much more volatile than gold. But it's just interesting to note that this beta has increased over the past year compared to the previous 3 years, I would say, as an average.
So as an anecdote, I bought my copy of The Silver Bull Market by Shane Maguire, and it was half price. So you can argue what you will from that. But I think it's fair. I think the sense I get from both of your comments is silver has potential to go up, but it's going to be very dependent on gold.
Yeah, but that probably means that once you see silver start to really take off, then that's a good signal that the conviction on gold's upside is much stronger than where we are right now.
Yeah, so it's almost a confirmation of the gold trade as much as anything. And then if we move on to the platinum group metals, how do you see platinum? Is that almost an extension of silver? It's a precious metal. I noticed there's a lot of negative words in what you've written. Is it almost an extension of the same story? It's a precious metal with this exposure to a real demand?
I'd probably put it more closer to palladium in the sense that fundamentals matter a little bit more for platinum than they do for silver, which is why I think, although there's a very strong correlation, or historically there's been a very strong positive correlation between gold and platinum. If you look at platinum's performance over the past year, it's been very reluctant to follow gold higher. And that's because the demand picture, I think, is really, really poor, and the hits just keep on coming, it seems. You have weak or you have that anticipated decline in auto demand because of the decline in diesel shares, and then on top of that, you're starting to see weakness in European auto sales themselves, and then you also have what's looking like a weak heavy-duty diesel market in the U.S. Jewelry demand, which is the other big component of platinum demand, has also been weak, even if you've seen gains in places like the U.S. or India. China remains quite weak, and therefore it just drags the whole segment lower. So it's not a pretty picture for platinum, and the only reason why I'm forecasting higher prices from here is because of gold. And even then, like so far this year, platinum has disappointed my expectations. I would have thought, gold at 1280 to above 1300 would drag platinum to, let's say, 875, something like that, but it hasn't.
Yeah, my rationale would be more also like platinum following gold. Also a bit surprised that platinum hasn't performed better. I would put a cap, given the weak fundamentals in terms of the automobile market and the diesel store. I would put a cap of $1,000 an ounce on platinum, holding all things constant. But the interesting thing, I think, guess between platinum and palladium is, at the end of the day, platinum has jewelry demand, 30% of it, which makes it more in the precious metals side of things. And that explains probably the correlation with gold, whereas palladium practically has no jewelry demand. 80% of it is just cars. So I guess the story from, you might want to pitch in and tell us your view on this, given that you're probably more knowledgeable than we are in terms of PGMs. But when it comes to like jewelry, is the fact that platinum is trading below gold has made it lose its luster within the Chinese market and made it into less prestigious. It had this, when it's twice the price of gold, it has this prestige value. Is it something that from your side you're seeing in terms of, all of a sudden it's just cheaper than gold and makes it less attractive to those who want to impress?
I'm always entertained when someone turns the tables on me and asks a question, but I think it's a very difficult question to answer because my experience of the jewelry sector of all of the metals is how anecdotal everything is, that you can ask two people the same question on the same day and get a different answer, and then ask them both the next day and they'll get the opposite answer back. So I think it's not so much, I think it's still the case that platinum as a brand is very strong, and that's particularly the case in Japan, I would say Europe as well. But I think it's still true in China. But what is very clear in China is just how fast the market changes. And we've seen the retail market changing, and you can see it in gold as well, changing from being weight-driven to being margin-driven. And margin-driven is all about design and about margin and about lightweighting pieces. And that seems to have gone very well with carat jewelry. So the K gold that the WGC has been promoting for a long time did nothing in China, and then has suddenly done really well. And it's interesting to say, is that a fashion thing, i.e., is it a transient change, or is it something else? Because I think certainly my experience of the market in China is it's very price sensitive in unusual ways. So rising prices might actually be the thing that people like the most, because a lot of the jewelers there actually quite like being exposed to rising prices. They treat it as almost a speculative gamble alongside what you're selling. So it's genuinely one of the most interesting questions. I can see, from where we sit as a platinum producer, we can see upside, but I don't think it comes naturally. I think it requires either higher prices, it requires market development, but I think the branding is still there. I think people still like the material, but liking is not the same as buying necessarily, and that's the step that needs to be forced forward from my perspective.
And probably also the branding, what helps keep platinum's branding is that usually it's what diamonds are set in, so it usually is used in more expensive, more luxurious pieces.
Yeah, because platinum watches are much more popular than these days than just yellow gold.
Yeah, I agree, and also that bridal sector as well. So the branding is there, but I think it's fair to say the performance hasn't been there in the last year. And then do you guys look also at the supply side on platinum, and also I guess on palladium as a factor that informs your thinking?
Yeah, from the palladium side, that one of the reasons why I'm bearish on the metal is it seems to me that it's like kind of an opaque world compared to, let's say, platinum. Basically, you've got the Gokran, you've got the Global Palladium Funds, you've got most of it is centered in Russia, and we're not seeing we don't have that much visibility when it comes to how much these holdings are. So can we see a situation whereby we're going to see a big sale of platinum at some point, a bit like a repetition of what happened in 2000 when it came to the export license? I know it's a different story, but it just highlights the importance of Russia when it comes to platinum supply and how quickly the market can drop. Because from a demand side, Chinese automobile sales are their weakest since 1990, and 80% of demand for palladium is from cars. We've seen a kind of a slowdown. I guess it's 3.5% in car sales so far in first 11 months of 2018. So the demand side doesn't look particularly exciting for palladium. So my question to you is yes, it must be the supply side, but it's so hard to see because of, I guess, the way the market is set up, the funds, the way they're set up in Russia. And even what's interesting is you look at physically backed platinum ETFs, they've dropped from something like 94 tons in 2015 to 22 tons currently. The market is so small in terms, we're talking about just around 300 tons. So it's a small market. It's probably easy to create squeezes in the market.
I look at supply, and I guess at this point it's much more of an issue for platinum, really, because it's a market that is forecasted or it's a market that has very weak demand. So even if you say supply is not growing, it's still, it's also not falling significantly enough to tighten the platinum market. Whereas for palladium, the impact of that is, well, you have relatively flat supply, whereas demand continues to grow and grow quite healthily. So you'll have a market that's already tight and only getting tighter if the supply side doesn't adjust higher or keep pace with the growth and demand. And just in terms of the China car sales, this is actually something that I get asked a lot of questions on, because it is a warning signal, in my view, that you're starting to see a decline in car sales. But what does help the market is that it's not really the amount of new cars that are being sold that is driving palladium demand out of China. It's really the increase in the loadings on the back of tighter emissions regulations. And I did some work and looked at my models, and basically if I look at the growth in palladium demand that I'm estimating for China over the next 5 years, actually only 10 to 15% of that growth comes from the growth in car sales. The bulk of it actually comes from the growth in loadings that I assume.
Okay. Another interesting point, I guess, from the supply side, just to mention, would be the importance and the weight that scrap has had in the platinum and palladium market. So 30% of supply for palladium is from scrap, and something like 25% of supply for platinum is from scrap. If you compare it with gold, it's just like inelastic. Basically, it's coming from recycled autocatalysts. So in a way, you have this dissociation between, if prices go up, do we necessarily see much more scrap coming in the market? You see that in gold. We would see that in silver, but you wouldn't necessarily see that in the in the platinum and palladium markets. It's coming from cars. Maybe if they encourage the Clash for Clunkers program, you might see that happening more. So there's this dissociation, I believe, in the price, and I think it's just so much scrap that keeps coming in that's probably weighing down, for instance, on the platinum market. And if you look at Apple, for instance, I guess there is a tendency in the market, generally speaking, to move towards trying to push to recycle more. So the ideal thing would be to have a phone that's coming from completely recycled metals, just general metals. I'm not just talking about platinum and palladium. So there is probably that nascent movement that's happening in the market. It'd be interesting to see the role of scrap 10 years down the line or so.
I feel very bad for finding 3 out-of-date iPhones in my house yesterday. They've not been scrapped yet, which I
should be quite rich.
Should be recycling. We'll do our best with them. But it's an interesting dynamic. I think palladium, for me, seems conceptually very easy because it's got one big application for its end use and it's got relatively few producers, but it doesn't necessarily make it easier to forecast. So I guess my closing question really is a very simple one. How do you forecast, from a personal perspective, something like the palladium price this year when it's moving around in the way it has?
Yeah, and it basically blew outside my my forecast right after I updated my forecast. It's very difficult it's a very difficult market to forecast because you don't have a lot of visibility on what's actually going on. The market is very small, and in fact, a lot of the feedback that I've been getting in recent weeks is that it's just a very difficult market for investors to get involved in. Because even if you get the direction right, you're not exactly sure how you got it right.
Yeah, I guess for me it comes just as quickly as it's gone up and rallied, it could just as quickly collapse. And I think it's just being driven by a few suppliers of the metal who, again, back to my comment about maybe Gokran, maybe the Global Palladium Fund, what's happening there is something we can't see. So that's the unfortunate situation, I guess.
Yeah, it's interesting for me. I joined the precious metals market in 1997. So occasionally I'm asked things that date back 20 years. But you're always learning something new. There's always new things happening. So,
but you saw, I guess, in 2000 when you had the rush, you had the palladium price just rise rapidly, and I think you had a few automobile producers in the U.S. that had bought at the top and just lost 1.5 billion because the Russians all of a sudden decided they wanted to remove the export bans that they had put in place. So it's been very interesting times for the market, and I wonder if we're seeing something similar in a different way, let's say.
Yeah, I think it reminds me of the old saying, because you can never swim in the same river twice. It looks like the same river. It may feel like the same river, but it's not the same river. The water is different. We live and learn, we hope anyway. So since I'm in a benevolent mood, and I have no desire to ask you any questions about your ruthenium or iridium forecasts, I think that probably wraps it up, unless you've got any last words that you want to say.
Not at all. Thank you.
That's it for me. Thank you.
Thank you, Jollie. Thank you, Bernard.